Well, my next guest would probably prefer to talk about 19th and 20th century art, but we'll stick to stocks today. We're talking to Scott Black. He manages nearly $1 billion at Delphi Management up in Boston. And Scott, of course, we're referring to your passion for bidding for art at auctions. I'm told that you actually bid against our mayor here, Mayor Mike Bloomberg.
A long time ago on a nice Monet of La Belle Ile.
Okay, sounds like something I will never be able to do. In any case, okay, the S&P hit the 1150 mark yesterday. Everyone talked about that being very key. Where do we go from here?
I actually think the market will continue to go upwards. Although my estimate for the S&P earnings is lower than many of the consensus, I'm at around $68, which puts it around a 17 PE. There's over $3 trillion still in money market funds. There's over another $1 trillion in money market equivalents in banks. And even with my earnings estimate, earnings per share for corporate America are up 19% year over year. So there's very good earnings momentum. There's lots of liquidity out there. We're not going into a double dip recession, and Bernanke's going to be accommodative with the money supply. So I think the trend is still upward for the year.
Scott, one of the groups you've been somewhat cool on, financials, but financials are actually the best performing group for the S&P this year. Is there a danger, even if you're not certain about the balance sheet story with all those names, that you miss out if you're sitting out of that group?
Well, you know what? That's the greater fool theory of investing. The idea in the Warren Buffett model, which we follow, is to buy a business. And if the company has the non-performing assets on the other real estate owned that's far greater than the reserve on the balance sheet, you're buying a piece of paper, not a business. We own some select financial service companies, but surely we're way underweighted. As of yesterday, it's about 16.3%, probably at Delphi, including insurance, banks, and brokers. We're probably half weighted in it. But we can't find good businesses. If you look at many of the money center banks, the regional banks, they're way under reserved, and especially if you look at the credit card portfolios, the commercial mortgages.
But even Warren Buffett likes some banks like Wells Fargo.
Yes, so do we. We own them. And I got a little one from my home state. We own Bar Harbor Bank shares, selling at a 7 PE with a 4% yield that's fully reserved. But those are very difficult to find at this point, Betty.
Hey, Scott, it's Adam. So if financials are kind of the intangible side, let's shift gears, talk about tangibles, basic materials. Take a stock like Cleveland-Cliffs. You know, they make the iron ore pellets used to make steel up 30% already this year. Is a stock like that overdone?
Well, we bought it at 29 and 30, and I guess it's had a big run. But you got to remember, on the prior peak, they earned close to $8 a share, and the stock was over 100. And they are the 5th largest producer of pellets in the world. We happen to own Vale and Rio Tinto as well. So I don't think that it's overdone. I think this, you know, if we believe that there's an economic recovery and steel's going to come back in the United States, I think Cleveland-Cliffs, which is now Cliffs Natural, is still a good play.
Now, Scott, we promised our viewers we'd get some of your stock picks. Methanol is one of them, a Canadian methanol producer. The stock is stuck at $25. What's going to drive it?
Couple things. It's called Methanex. They're the largest producer of methanol. They produce in Chile, Trinidad, New Zealand. They're building a new facility in Egypt. The bottom line is they're getting price inflation, and the volumes are going to go up because they're only at 57% of capacity. So you're going to earn about $1.90 to $1.95 this year. So it's about a 12 PE, and we think they're going to earn north of $3 next year. It's an 8 multiple. And the prior peak earnings were over $4, so you're paying really only 6 times the prior peak. It's 1.8 times book. The balance sheet's clean. The coverage ratio is solid. It's 12 to 1 in the latest quarter. So I think this is a good industrial play. For those of you who don't know, methanol is a building block chemical that's used in everything from paints to textiles to plastics. So, you know,
And Bunge, I just want to get to this. Bunge, the quietest $40 billion company you've never heard of, is what you describe it?
It is. They actually did $42 billion in revenue. It's a little bit like a Cargill or Archer Daniels Midland, but they have a huge focus in Brazil. They also in the ethanol business, where they have 5 cane sugar ethanol plants. It's selling right at book value. The stock is 1.01 times book, 1.05 times tangible book, selling at 10 times this year's earnings and approximately 8 times next year's earnings. And that's half a market multiple. You've got earnings acceleration behind you, and it's a good play on the emerging markets as well.